Hello folks, this is Bob Abraham from Spectrum Financial Resources with a March 2016 Educational Economic Update. In this video, we'll talk about some of the economic headlines that influenced markets in the last month and give you some insight into what they could mean for you as an investor. Please stay tuned at the end for a required disclosure statement. After a rocky January for stocks, February didn't offer investors any respite. Volatility was still the name of the game. However, we did get some positive news. Let's talk about some of the month's major headlines. If you have been watching the news, you've probably heard a lot of folks talk about the possibility of a recession ahead. Is a recession coming? Some economists are worried about a U.S. recession because of issues like low oil and commodity prices, emerging market problems in countries like China, and fears that central banks are out of tools to fight economic trouble. These fears are not baseless. However, they don't necessarily spell recession. There are also a lot of positives to consider. One indicator that argues against the coming U.S. recession is the labor market. The January jobs report showed that the economy gained 151,000 jobs that month. The gains pushed the headline unemployment rate down to 4.9%, the lowest it has been since February 2008. Another positive is that wages are growing and Americans are continuing to spend money, which is a good sign for the economy. In short, we don't know if a recession is coming, and neither does anyone else, regardless of what they say on TV. Recessions don't just happen for no reason, but we are taking the concern seriously and watching fundamentals carefully. Plummeting crude oil prices have had a lot to do with negative sentiment in recent months. Crude oil prices are so low because the world is awash in it, and the supply glut combined with the slowing demand from China is pushing down prices. Investors worry that persistently low prices mean that the global economic growth situation is growing worse. Low prices also cut into energy company profits as well. Those of the companies with stakes in the energy industry, with 87% of the S&P 500 companies reporting in, we see that overall S&P 500 earnings were down 3.6% in the fourth quarter of 2015. However, if we remove the energy sector from the analysis, earnings actually grew a healthy 2.5%. Firms that mostly depend on U.S. demand did even better. The overall economic picture wasn't as bad as expected last quarter. The second estimate of Q4 economic growth showed that the gross domestic product grew 1%, not the 0.07% originally estimated. While economic growth decelerated in the last 3 months of the year, it didn't slow down as much as economists had thought. Responding to concerns about economic growth, the Federal Reserve declined to raise interest rates again in its January meeting, keeping them low to help boost investor confidence. While the Open Market Committee will meet again in March, most economists don't think the Fed will hike rates again until June at the earliest. Bottom line, 2016 has been a rocky road for investors, and the volatility is likely to last for a while. While corrections and uncertainty aren't easy, let's remember that they are coming after years of solid equity growth. We are keeping a close eye on fundamentals and helping our clients make informed decisions based on the latest research. If you have concerns about your personal financial situation in the current market, please give us a call at 248-643-0033. We would be happy to speak with you. Once again, this is Bob Abraham with Spectrum Financial Resources, signing off for the month of March 2016. Please remember that nothing we talk about here is a recommendation. If you would like to discuss your personal financial situation, please give us a call at 248-643-0033. We'd be happy to talk to you.